Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, just retired from nearly 50 years of being in the brokerage business in BC. His website, victoradair.ca. Welcome back to the show, Victor.
Well, thank you, Jim. Good to be back with you.
Victor, yesterday you posted a new blog on your website, victoradair.ca, declaring a new commodity bull market began in April 2020. What are the critical points in that blog?
Well, Jim, I will go back a year and change. In February of 2002, I opened the World Outlook Conference with a bullish report on commodities. I was of the view at that time that I thought a bull market in commodities was sort of just around the corner, and I set out what I called the ideal conditions for what a bull market would look like. So then fast forward here just to the beginning of this month, and the conference this time, instead of being in a hotel, was virtual with all the, the social distancing issues we have these days. But this time around, I said that I guess my main point is that commodities, like the broad commodity indices, and there are several of them that are weighted in different ways, but you get the big picture. Commodities are just extremely cheap here relative to stocks and bonds. If that was maybe my key message. And of course, going along with that, I do continue to think that over the next couple of years, and that's important, time frame, Usually I'm very short in my time frame with my trading, but over the next couple of years, I'm looking for the commodity indices generally to outperform stocks and bonds. Now, I had a couple of reasons for that. One I called financial reasons. The other were supply-demand reasons. And let's say on the financial side, to me, the big picture situation here is that we've had massive expansion of the currency supply by government central banks as they try to address, the virus issues. And I think that people around the world are kind of getting the sense that the government and the central banks are going to try to inflate their way out of a problem of way too much debt, and that people will be buying real assets. Now, I don't think they're going to just, stop buying stocks or stop buying, well, to some degree they will stop buying bonds. But it's just, I think that the commodities are going to look so cheap that there will be a bid come into the commodity market, maybe even some capital leave bond markets and stock markets and go over to the commodity side. That another reason here is that with interest rates basically at the lowest levels they've been at in history, that for people that would have a balanced portfolio, and in simplest terms, I mean they would own some stocks and they would own some real estate, but they'd own some bonds. And the bonds were going to be sort of a counterweight to the stocks. Okay, with interest rates at these levels, bonds just aren't that much of a counterweight anymore. And I think it would make sense to me, if I had a portfolio like that I would sell off some of the bonds and actually buy commodities as a counterweight or a balance in a portfolio against my stock holdings. On the supply-demand side, and this is where it really gets key, in the last 10 years, we've been in this brutal bear market on commodities, where the capital has just deserted commodities in effect and gone to stock market because, you can't go wrong buying stocks. So there's just not been enough money spent around the world to develop the production facilities, call it just new sources of supply. And as demand picks up, and at some point we come out from under the virus lockdowns and so on, we really run the risk of there's just not enough stuff, to go around to meet demand. So supply-demand, I think, is a very bullish picture for commodities. The supply-demand issue is exacerbated by what, broadly speaking, I'm going to call ESG, the environmental governance sort of issues. On the supply and the demand side, where it'll impact supply is that call it climate change and ESG rules and regulations and thinking is going to make it tougher and more expensive for to develop new sources of supply of commodities. On the demand side, going to be a positive there. For instance, we've certainly seen copper, lithium, two things that just come to mind here, who've had big price increases. People are anticipating that the climate change ESG requirements are going to dramatically increase the demand for some commodities. And then also on the supply side, we've seen China has been a big taker of commodities, and I think the world, including China, as we come out from under the lockdowns, we'll see a big kick up in the demand side. So that was kind of the main points, but just to go back to one thing I'd said the year before, here are the ideal conditions that you'd love to see for a commodity bull market. And at the top of the list was, a very expansionary monetary policy, very expansionary fiscal policy, two of the things we have. U.S. dollar, weaker, it's down 10% from where it was a year ago, and so on. So we have like an ideal background now on the big picture side for a bull market in commodities, and certainly we've had a leg up. The broad indices here from the lows of last year to where we are now are up, say, 80 to 100%. So we've had a pretty good run from those lows. And just to wrap it up, through the presentation, I show folks, how you would participate, whether you want to look at the futures markets, ETFs, mutual funds, individual shares. And one of the things I pointed out was commodity currencies. This is a very simple, straightforward way to participate in a broad commodity boom would be to look at the commodity currencies like the Canadian dollar, Australian dollar, New Zealand dollar, that sort of thing, Russian ruble, Norwegian krone, even the Mexican peso have a high correlation to the ups and downs of commodities. So, and the last thing, Jim, and this is really important, is timing. I said this is not the time to step up and buy commodities. We've had this big kick up off of the lows from last year, to say 80 to 100% gain in some of the broad commodity indices. I think that's been part of the reflation trade that we've really seen here, particularly the last 4 months or so. And I think WTI is up about 75% since the beginning of November. So I'm looking for a correction in this rally we've had in commodities from last year's lows, and really the point of my talk was to say to folks, wait for this correction to kick in, and while you're waiting, have a look around and figure out how you're going to, participate in the commodity boom, which I think will, the next leg up, which I think may get underway, let's say, in the next few months.
Well, since last March's crash on the 23rd, we've had a great rally on the broad stock market. Some stocks have had spectacular gains, but given that you think now is not the time to buy commodities, do you feel the same way about buying stocks?
In a word, yes. I think we've had spectacular is maybe understating it, the rally that we've had from the lows of last year. Now, put that in perspective. In early February of 2002, the broad indices were trading at all-time highs. Along comes the virus and the panic that went with that, and we fell into a very quick and steep, deep hole. But at the lows there in March of 2020, the Fed and other central banks came in huge. That was Powell even talking about, this is not the time to kind of tiptoe in. You come in huge. Very shortly after that, government stimulus programs, huge. We had the psychology in the market was kind of a Tina. There is no alternative. They got interest rates down to nothing. The people next door all around me are making money jumping into the stock market. I got to get in too. And then you have the FOMO, fear of missing out. That was driving things. We really had these speculative excesses in certainly certain markets, and especially in certain stocks. Tesla comes to mind, for instance. And then you had this whole thing of, the retail boom. And that, I'd say, really kicked in a gear, by last summer, certainly around the time of Joe Biden being elected at the beginning of November. And then a few days after his election, the Pfizer announcement comes out. They've got, the wonder drug where we got the cure for this virus. That was kind of the psychological thinking in the market. Now Biden's elected. His promise basically is they're going to go big in terms of even more stimulus, green stimulus. So the what do they call it? The high pressure plan for the economies, that sort of thing. At that same time, as I've written about on my blog a few times in the last month or so, it seems as though what I call old school valuations just don't matter anymore. Who cares what the unemployment rate is? Who cares what price to book is? Who cares about any of that stuff? It doesn't matter. It's all this psychological game of stocks are going up, and if you don't get in, you're going to miss out. So that's been sort of the epitome, I guess, of speculative excess. So, Biden, I think right now, he's in the honeymoon phase, and maybe, as it starts to, for instance, this morning we had retail sales come out much stronger than expected. That is going to play right into the hand of the folks in the Senate that are saying, are you crazy? 1.9 trillion? Not going to happen. That sort of thing. So Biden has come in. I think there's great hopes that he's going to turn the world around, as it were. And in a word, Jim, I think the stock market is very ahead of itself here, and that's why I think this whole reflation trade that has boosted the stock market. And the reflation trade just means, hey, when we finally get this virus licked and everybody gets back to work and the lockdowns are lifted, there's going to be pent-up demand like you can't believe, blah, 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 that sort of thing. I think we probably priced all of that in and some more. So I am not a buyer at these levels.
Interest rates have been rising lately, slowly, but still rising. Is the market getting worried about inflation?
Well, let's say that's the $64 trillion question. Interestingly enough, interest rates in the United States, whether you're looking at the short end or the long bond, hit their lows pretty much to the day that gold hit its high last August. And we've had interest rates. Now that's nominal rates, okay? The real rates actually got a little bit lower as we went along. But in the last 3 months in particular, we've seen the long end of the market, let's say the 10-year and further out, prices have been coming off while, the short end, the Fed's got their foot on that. That hasn't moved. So that means the yield curve is getting steeper. The difference between, the yield on a 30-year bond and a 2-year note. Interest rates going like that, or the curve going like that, I say, and interest rates themselves rising from a time when, with these really, really low interest rates, we had a mortgage boom in the United States, which feeds into housing prices that are stronger because more and more people could afford a mortgage on a house. The lower interest rates that we had were behind everything, and in terms of low interest rates, we've had a 40-year trend of lower and lower and lower interest rates, and that has been a wonderful environment, particularly for the stock market and the real estate market over that long period of time. I think we have seen the lows in interest rates. Now, it would be a pretty bleak world, I think, if we were to see at some point in the future, 6 months, 12 months from now, that we were at even lower interest rates than we've ever seen before. I don't see that happening. And certainly the central banks don't want to see the market go anywhere near a deflationary environment. So the stimulus stuff will just continue. And I think that people have a choice about, do I want to hold on to bonds will probably start to say no, and interest rates will continue to rise. And I think one of the things that is motivating them to say, I don't want to own bonds anymore, is you can smell, inflation is starting to pick up here with all of this stimulus, and I think that's going to be an enemy. It's going to be kryptonite for the bond market.
We'll have more with Victor Adair right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Victor Adair. Victor, when we talked a month ago, you thought the U.S. dollar had made a significant low on January 6th and would continue to rally. Do you still think that way?
Short answer, yes. On January the 6th, we had we'll call it the storming of the Capitol building, and that was recently the Democrats have tried to impeach Trump on the thought that he incited that to happen. Whatever. I remember the next day I was thinking of that as a cathartic inflection point for the U.S. dollar. It had traded at the better part of a 2.5-year low or something that day. The sentiment on the U.S. dollar was extremely negative. Positioning was very bearish. In other words, everybody and his dog was short the U.S. dollar. And then you had this thing that happened. I mean, I remember watching on the mainstream medium television shows what was going on with these people trashing the inside of the Capitol building, and I just felt this is incredible. And the thought of it being as the Rothschild might have said hundreds of years ago, you want to buy when there's blood on the streets. I mean, this was amazing that this mob, as it were, had invaded the legislature. So then we get to currencies, and there are folks that will say, well, the dollar is trash and not worth the paper it's printed on, and so on. And I would say, well, is a euro or a yen or a pound or whatever any different? So in the world of currencies, you're trading one currency relative to another. And in this case, dollar versus the euro. I mean, if you think the dollar's got problems, I'm going to say to you, I think Europe's got worse. So if you just kept it that simple, I'd be a buyer of the U.S. dollar against the euro. Part of the thinking right now in the currency market, I guess, is that maybe with all of this stimulus, this aggressiveness from the government and so on, and as I mentioned earlier, we saw this retail sales number this morning that was way stronger than expected for the month. And maybe America, recovers faster and stronger than other countries, and that puts a bid into the U.S. dollar. I think part of the lift in the U.S. dollar we've seen the past few weeks has been some short covering. I said it was massively short. I think if the dollar starts to tick up a little higher, we may see some folks actually start to buy it. Now, the currency markets have not been monolithic. Given the kind of commodity boom that we have been having here sort of the past few months, we've seen the commodity currencies like Canada, Australia, New Zealand have been outperforming the euro and the yen. Over in Europe, the British pound has been definitely outperforming the euro currency since Brexit. It's kind of like now that the British pound, now that England and, not England, the UK is not tied into the euro, the European Union as they were, being freer, the pound is going up. The Chinese currency has hit a 2.5-year high here just in the last couple of days. I think that's been important, although it's not a major currency in terms of being traded in the markets. I really keep an eye on the Chinese currency. It's so important in Asia that it's going to have some bearing on the other currencies. The Japanese yen has been weak. To keep it simple again here, I think the U.S. dollar could be doing better. I'm going to be inclined to be a buyer of the U.S. dollar, but it's just against what? Maybe I'm more inclined to buy the U.S. dollar against the euro than against the Canadian dollar, for instance.
We'll have more with Victor Adair right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, in the new commodity bull market blog on your website, you point out WTI crude has jumped about 75% since the beginning of November. You say the rally in crude is part of the reflation trade, and you expect to see prices fall before they go on to take on new highs. Your thoughts on crude?
Yeah, crude, let's give a little background. I mean, before the virus news start to be, mainstream, like at the beginning of 2020, about 100 million barrels a year in demand. And at the height of the virus problems, demand was down about 10% or so. Production came off. U.S. lost production. OPEC and friends cut their production. So we really had, and prices took a real tumble, even with those cuts on supply. As you may remember, we went negative pricing on crude oil very briefly in April of last year. So since then, since that hole we got into in April, crude oil has come back, and as you point out, certainly in the last few months here, it has really rallied. And the reflation trade is maybe a shorthand for what things are going to look like once the virus has been dealt with. The vaccine rollout, we're not having the lockdowns and so on. And we are back here at $60, $61 a barrel in WTI to about where we were at the beginning of last year. So it was so interesting that just this morning there was a ripple went through the market that the Saudis, who had sort of out of nowhere a month ago at an OPEC meeting, had volunteered that they would cut 1 million barrels a day from their production, and that helped give prices a boost. Well, you had to know it sooner or later they were going to say, okay, we helped out, now we're going to come back. And there was an announcement this morning that they would increase their production by 1 million barrels a day. It seems as though, before I make a wrap up, let's do a segue to Texas. I mean, it's just been amazing what has happened here in Texas with this polar vortex weather that's come sweeping down from Canada all the way down to the Gulf. Texas, huge numbers of people without electricity, oil and gas facilities freezing up in the cold, and just to put what do they call it, poke you in the eye with a stick. The wind turbines freezing. It would seem, this is going to cause a whole lot of people to rethink the idea about let's do away with using fossil fuels, whether it's nat gas or crude or what have you, and we're going to just go to renewables. So I think the whole green movement that we've had that's been building and at an accelerating trend here over the past couple of years is maybe in some ways, like the stock market, has really got ahead of itself, and there's going to have to be some rethinking about that. But in terms of, I think we will see higher prices on crude ahead. Do we get to $100? Not right now. I really do think that crude, just like the stock market here in the last few months, it's been an excessive run to the upside, exacerbated here in the last several days by this polar vortex that's swept across America. But I think somewhere in here we're making some highs, and that we will have a correction, and then we go on to make new highs. That's sort of roughly the picture I have in mind.
And it's a pretty grim picture we're getting about summertime gasoline prices. They're saying Vancouver, which is about $1.40 a liter right now, will go to $1.70. That's $6.46 a gallon Canadian, $5.03 US a US gallon. So that's what we have to look for. And by the way, have you noticed, Victor, every spring the oil companies always have a reason for putting up gasoline prices. It's usually an explosion or fire. But now they have the Texas polar vortex snowstorm to blame. So there's always something that they use to boost the price of gasoline before the summer driving season even starts.
Well, I do know that the wholesale gasoline price that we trade in New York was about $1. Just before Biden was elected, it was $1.70 here yesterday, roughly speaking. So that was a pretty stiff increase just in the last couple of months, and that's been I'm saying that's been very much the market looking forward with anticipation to what this pent up demand that was going to happen once the virus lockdowns were lifted, and in the very short term, certainly events in Texas here have just, exacerbated that run to the upside.
Well, Biden clearly is against oil and gas, so is that good news for Canadian oil and gas?
I'll tell you what. Let me phrase it this way. I was saying in my piece, that's the commodity piece that's on the blog, where I put up the slides that I used at the conference. I said to folks, you just really want to be careful about how you go about participating in the commodity boom. For instance, do not buy something because you think it should be going up because something else is going up. For instance, you think the price of crude oil is going up, so what you should do then is go out and buy the shares of a company that produces crude oil. Not necessarily. And I'm saying, well, because typically you figure you're going to get a lot of leverage by buying shares in the producer, because the more the price of the commodity goes up, their operating earnings are going to expand in an exponential rate. But I'm saying this whole ESG thing, this would be a negative side to the ESG, is there would be people, let's say it's a university, places a couple of $100 million with a money manager, and they say, we want you to make money to fund our programs, but we do not want you investing any of our money in that dirty oil market. So there's going to be, at the institutional level for sure, and certainly at the individual retail level, there are going to be some folks that do not want to buy shares in oil and gas companies. So you could have a situation where the price of oil is going up because of the demand that I'm seeing, but, people are selling the shares because, they want to, if I could go out on a limb, they want to be virtue signaling, or they just believe that it's wrong, just wrong to own shares in a tobacco company or an oil and gas company and so on. So, you want to be careful what you choose to buy. You could be very right about a commodity boom and buy the wrong thing and not make any money.
Mm-hmm. Do you think soybeans and corn, which have also had a massive rally since last summer, will follow the same path as crude?
In the short term, yes. Since last summer. Now, wait, give me a moment here for background again. I mean, for the past few years, you've just had ideal growing conditions, and the innovations in agriculture and so on, the corn and soybean market have been in the doldrums. The supply has been terrific. So then this past year, with, zero interest rates and everything else happening, we had China was a big taker. They'd made a trade agreement with the United States, but they really bought a lot of beans and corn. So you had the price of Corn was up 90-odd%. Beans, I think, was about 75% from about last summer to just very recently. Similarly, kind of a same sort of a price pattern run to the upside that we had in crude. On a short-term basis, yes, I think very much. I think corn and beans are very overbought here, just like crude's very overbought. Although I think over the next few years we'll see prices higher. I just wouldn't step up and buy them right here. I'd wait for some sort of a correction here over the next couple of months.
Gold has fallen nearly $300 from the all-time highs hit last August. What happened to gold, and where does it go from here?
Well, over the past few months when we've talked about gold, I've said that I thought the most important thing for the gold market in terms of the buying or selling was the North American and European buying of gold ETFs during the sort of the March of last year to July period. People bought a record amount of gold ETFs. And during that same period of time, the typically strong retail markets in China and India just turned their back on the gold market. So boy, oh boy, the gold market really needed that ETF buying. But I look at that data, and I'll tell you that since September of last year, right through to the end of January, which is when we have the monthly data, we've seen net selling of gold in the ETF market. So those folks that were buying gold when the panic was happening in March, and then as the gold ran to make new all-time highs at the beginning of August, so that inspired people that are buying stuff that's going up, that was the run for the roses in gold. Since then, the price has drifted down, and as it's drifted down, folks have not been buying in the ETF market. They've been net selling, and it could just be as simple as, hey, we did pretty good on gold, and we ought to take the money out of that and put it into something in the stock market, some high-tech stock or some of the new things that are in fashion these days. So I think with gold, in terms of my multi-year bull market that I see ahead for commodities, I think gold prices will go higher. And I'm actually thinking gold may be leading the other markets. In other words, we've been in a correction for the past few months on gold, so maybe I'd look to be, for instance, a buyer of gold before I would buy some of the other commodities. Let me point this out, too, in terms of what you want to buy. Sometimes people would look to buy gold shares instead of gold because of the leverage. In other words, a gold producer who's making X number of dollars at $1,500 an ounce on gold, if gold goes to $2,000 an ounce, he's going to be making, the company's going to be making a lot more. So there's leverage there. Since 2018 to now, just roughly speaking, gold stocks have got about twice the zip to them that gold has. So we've seen gold down about 14% at today's prices from the all-time highs in August, whereas gold stocks are down 25 to 30%. So maybe double the beta. So if you're really excited about the gold market, and gold shares now have been really clobbered pretty good, you might look to buy gold shares instead of gold, or as well as gold going forward, just to get the extra kick that comes, the extra leverage that comes from owning the gold shares.
Before we wrap up today, a little bit of advice from you. You've been trading for nearly 50 years. You've seen all kinds of markets, ups, downs, crashes, recoveries. Are you doing anything different in the market these days than maybe you did in the past?
I'd say probably the thing that just immediately comes to mind is I trade smaller size. Now, if I go back to the 1980s when I was a younger fella, I was in my 30s, I would trade very aggressively. If I didn't have a dollar in my margin account that wasn't being used. And, I had some pretty spectacular returns and some pretty spectacular drawdowns. There's an old saying in the market that there's old traders and there's bold traders, but there are no old, bold traders. And now that I'm older, although I still kind of think of myself as just a teenager, I am definitely more careful about my size. I've said before, another old saying is, when the market is going your way, you just can't have a big enough position. You can't have enough on. But I'll tell you, when the market's going against you, you not only wish you'd never put on the trade in the first place, but you wish you had not bought so much. So I definitely trade smaller size, and that makes it easier for me to, say, not panic in or out of a market. I'm going to make a more rational trading decision. And I think that's good, given that the price swings that we have now, I think, are more manic, more intense, and maybe go further than they might have before. Although I've kind of always had a thought that when a market gets on a tear and starts going somewhere, it really just goes way further than you could expect. Markets go 24 hours a day now. You can step in here in the morning and go, holy mackerel, what happened overnight? So, yeah, I trade smaller size. I'm much more cognizant of keeping the time frame of my analysis in sync with the time frame of the trades. For instance, today I've talked about two different time zones, the time frames. I've talked about for the next couple of years, I think we're going to have a commodity boom. But for the next couple of months, I think just the opposite. I think the market's gone too far and it could back up. So if somebody said, if we're going to have a commodity boom, let's step in here and buy it. And 2 months from now, you might really be struggling to hold on to that position or think I was crazy for suggesting you do it in the first place. And one thing I'd wrap up with, Jimmy, is that I now know that I don't know nearly as much as I used to think I did. I at one point in time where I was, again, 40-odd years ago, I was the global currency analyst for a major commodity brokerage firm. And, I worked very long hours, but I really thought I understood why the market went up or down, particularly the currency markets. These days, I'm much more willing to admit I don't know why it went up or down. I may have some reasons, but I may be right or may be wrong on those reasons. And there's a real risk, I think, or a danger. If you think you've figured it out because, you made money in your last couple of trades and say, I've got the hang of this now. I know what's going on. I'm in tune, you might have been right for the wrong reasons. And now you've really put yourself in a position of danger. So, and the last thing is, obviously, it kind of ties in all that. But risk management is just way more important than the crystal ball. I just keep reminding myself it's only a trade. I own something, it's going up or it's going down, it just can't be a big deal. It's just a trade, and when we close this one out, I'll be looking to put another one on after that.
Victor, thank you so much for chatting with us.
Jim, it's always fun. The time really wheels by, and I look forward to talking to you again.
My guest has been Victor Adair, just recently retired from nearly 50 years of being in the brokerage business in BC. Check out his website, victoradair.ca. If you have any questions for Victor or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.